All right, episode 2 of Behind the Camera. I'm your host, S.A., and we have our friend, attorney Darryl E Robinson, with us in this beautiful South Beach, Miami. And we're going to talk a little bit about investing, financial independence, retirement, amongst other things. Darryl, how you doing today?
I'm doing well, especially being down here in sunny Miami Beach, enjoying myself, having a good time, good weather. Absolutely. Glad to be back for a second time.
Good. So I want a few questions we're going to get into today. I want to know a little bit about what is financial freedom or financial independence, and how do you achieve it?
Okay. Financial independence or financial freedom, it depends, all right, based on the generation. The older generation, financial independence, were getting a job and working for 30 years and getting a pension and retiring in what they call a good life. For the younger generation, financial independence is different. It's about achieving flexibility in terms of lifestyle, right? And so it can be achieved in a number of ways. Obviously, corporate America has done away with pensions. So now you are more responsible for your own retirement and your own financial independence, which is not a bad thing because it allows you or encourages you to invest in yourself. And so financial independence for the younger generation comes in different forms. It depends on, you got some younger folks who want to use what they call the FIRE movement.
Right.
And which they want to get out of corporate America in 10 to 15 years.
So what is the FIRE movement?
The FIRE movement is extreme investment. So typically what they do is that younger individuals invest 50 to 70% of their salary in the market and in stocks and Roth in terms of that for 10 to 15 year period of time. And that investment gives them enough, at least what they believe, to live off for the rest of their life. But they're able to do that because a lot of them are single, not married, or they live at home with their parents, where they can put away 50, 70% of their salary. They forego the pleasures of the day. So there's a sacrifice of doing that.
And this is the retire early.
That's retire early.
Financial independence, retire. Is it retire early? Yeah, financial independence, retire early.
Exactly.
So that's what the FIRE Act
That's what the FIRE movement is in terms of that. I personally believe that you should have a hybrid of both as far as that is concerned. I think if you don't really need to retire at 35, and there's a chance your money going to run out, so that's a risk you want to take as far as that is concerned. If I was in my 20s, I think anybody, particularly for the younger generation that's listening, anyone who's in their 20s, as far as that is concerned, yes, start investing early if you can. A lot of them make good money coming out of college now. Maximize your 401k if it's offered in the workplace.
Okay. Before we get there, let's go back here. Let's go with what are stocks, bonds, index funds. Let's go a little bit and tell people a little bit about that.
Okay, well, stocks are individual equities that you invest in the corporate. That's what a stock is. So Apple stock or Amazon stock, you can buy individual stocks, and stocks vary at certain prices depending on the value of the company as far as that is concerned. So you can invest in a stock, and you do that by registering with a trading platform, right? Like an E-Trade or a Robinhood or someone like that. There's various platforms out there. You choose which one you're more comfortable with. So you buy stocks in terms of that. Bonds are a little different. They offer lower returns, but more security. As far as that, you buy a bond and they have bonds and they have a certain maturity standpoint, right? In terms of that 10-year, 15-year, 20-year, 30-year bonds as far as that are concerned. Or you have government bonds, right? Government bonds, and they have different type of investments and returns. And so mutual funds are really just a collection of stocks or bonds. For example, an index fund, S&P 500, is a mutual fund that consists of 500 different companies. So you get, when you buy the fund, you're really buying 500 different companies at one particular time. Yes, exactly. And so something like an index fund is what I would recommend to a passive investor. People who don't.
A mixture of both in their stocks and bonds in this index fund?
You can get those. You can get those because they have different type of index funds. They got bond funds, they have stock funds, and even within the stock funds, you have different families. You have what is called small index funds. And so the size of the name of the fund, you have small, you have medium, and you have large cap. That's what they call them. Medium cap, small cap are really based on the size of the company. They group them together. Like the top so many companies, they're based on their net worth or value would determine what category they fall in as far as that are concerned. But like for the passive investors, they should use the index fund because if you're not going to really take the effort to learn, which is best for you, which is the best fund to invest in, then go with an index fund. So you're tied to the S&P 500 index, and it's a lower cost fund, and you let them do the investment for you.
That should be over a longer haul.
Over a longer period of time. Yeah, you should use funds, primarily, in my opinion, index funds for retirement purposes. So invest in those funds. And so if you can, your goal should be to maximize your contributions that the IRS allows you to do pre-tax first. And then once you reach that, then you should go to the Roth IRA. The government allows you to invest up to a certain amount of money, usually around $6,500, $7,500 if you're over 50, into a Roth IRA. Benefit of a Roth IRA is that you don't pay any taxes on the money once you draw it down years later on the gain.
So if you don't take it out early.
Yeah, if you don't take it out early, right? You're
supposed to.
Right.
You don't have to pay,
you don't pay any taxes on the Roth. That's why they limit how much you put in. Otherwise, everybody be throwing money up.
Okay. So let me ask you this. Now, if you was younger in your 20s and you just starting your career,
yes,
you should set up some kind of financial goals.
Oh, absolutely.
In a budget.
Oh, absolutely.
To start thinking this way.
Exactly.
How would you advise somebody who's just starting their career to start trying to set up if they wanted to retire early?
I would say it would depend. If they want to retire early, comes in a number of different forms. First of all, ask me, what age are you talking? And you're talking about retiring early.
Maybe 40?
At 40. Okay, if you're in your 20s, you want to retire at 40, then you're going to absolutely need to maximize your 401k and take advantage of the Roth. Because you don't have a lot of time. Because if you're talking about 40, you average student graduated around 22, 23, you got 17, 18 years. That's it. And so the traditional rule of thumb is that your investments double this is a rule of thumb to use, people. If you every 10 years at 7% return, or every 7 years at a 10% return, it's best to use a more conservative one at 7% return every 10 years. So if you're talking about retiring at 40, you're gonna need to get a lot of money in the market fast. And the best way to do it is to maximize what you can according to the IRS, but also understand, a lot of people don't know this. Pre-tax, post-tax, you're able to invest up to $66,000 a year. A lot of people just look at what the IRS maximum is of $30,000, including, well, it's $27,500 if you're not over 50.
Okay.
If you're over 50, then they have a catch-up provision. But what a lot of people don't know, post-tax, the IRS allows you to put in a lot more. So you can do it that way. But I would recommend using the Roth first before you do post-tax, because the Roth investment grows tax-free. So that would be the first thing to do.
So while you're young, should you try to get different hustles to try to get this money?
Oh, absolutely.
It's going to be hard to try to get that money to invest.
Absolutely. Yeah, a lot of times, like I said, it depends on what your income is, right? So if you come out of college and you come out of one of the incomes that's more in demand, like you do coding, you do software engineering, you may start off in a six-figure job and you have an ability to be able to do that. But a lot of that, too, is contingent upon where you live. If you're in California or in Austin, Texas, or in New York, where it's a high cost of living, then housing is going to take up a great percentage of your salary. So, yes, if you had a time, you should, in your 20s, make the time. Get a side hustle. Even take the side hustle money and put it away. Trust me, over a period of time is your best friend. That money would accumulate. It'd be great down the road.
Okay, is this the right time to invest? Because I know a lot of people are talking about cryptocurrency, all of those type of things. And the inflation and the way the market is, it's up and down right now. Is this a good time to jump in?
It's always a good time to invest, especially if you're younger. You always got to have a long horizon. I remember Warren Buffett made a statement that if you can't hold it for 10 years, then don't hold the stock for 10 minutes. So get into it for a long-term horizon. So anytime is a good time to invest, particularly when you're young. Don't look at the stock market. Just decide what you want to invest in and go from there. As far as that's concerned, don't touch it. Now, how the market is doing mostly influence people who are toward the end of their career. And so then you may want to change your mix of investment and put some of your money into a more conservative investment, right? In terms of like in cash, as far as that's concerned. But it all depends on you, when you're going to stop working, how old you are, as far as that is concerned. If you retire early, I would never recommend you put your money in. For the FIRE movement. If you say I'm going to retire at 40, I would still keep a 20-80% mix, 20% cash, 80% stock. Because
you're talking about that, we got down here asset allocation.
Right.
And that's putting money in cash.
Yeah, put money
in stocks and bonds.
And bonds, exactly.
Is there a balance?
It is a balance, but the balance depends on when you retire, right? When you're going to retire and when your age, as far as that's concerned. The younger you are, the higher percentage of stocks you should have. Because stocks will help you fight that inflation fight. Because inflation will eat away at your cash.
So you wouldn't suggest...
Yeah, so I wouldn't put the majority of money in cash unless you're 70, 80 years old. You're like, I might die before I spend my money. That's different, right?
So the majority in stocks.
Yeah, majority in stocks when you're young, because you want to obviously beat the inflation fight as far as that is concerned. Because if you put your money in a money market account in cash, they're giving you 1%, inflation is 3%, you lose the money every year in terms of that. That's why the wealthy don't keep their money in cash. They keep emergency funds in cash, so always keep that emergency fund. because that's important for financial independence. Because emergency funds help you when something comes up and you ain't got to use that credit card. Because now you're paying 23% interest. So so there should be some cash.
Okay, now what is the difference between assets and liabilities?
Well, assets are things that you own. Car can actually be an asset. A depreciating asset, but it can be an asset. A home can be an asset. Anything that you own is an asset. A liability is what you owe on that asset. It becomes a liability if you owe a debt, right? Credit card is a liability. Your home is actually an asset and a liability.
A home like halfway in
exactly.
if you don't own it.
Exactly, because you still owe a mortgage on it in terms of that. But then you want to look at your net worth. For example, if your home is worth 300 and you owe 150, that 150 is a liability, but you have an asset of 300. So your net worth is 150. So that's how that works.
Now, is there a difference between buying, like, if you trading on one of these platforms where you can get the app and download and do it yourself? Is there a difference between buying like a stock from AT&T or Apple than it is getting it from your 401k retirement? It's the same thing?
Basically the same thing. It's just that you're buying it. Most retirement funds don't let you to buy individual stocks, but I've heard there's some that do in terms of that. But you buy them at the same price as far as that is concerned. However, when you buy them typically through a retirement fund, you're buying them as a part of an index fund or as a part of a small cap, mid cap, or large cap fund. Or if it's an international stock, it's a part of an international fund. So you're buying into the fund. What buying into a fund does is minimize the risk of loss because it averages out the gains and the losses of all the stocks that are in the fund. That's the benefit of a fund. So that's primarily for passive investors as opposed to people who are actually aggressively investing in stocks and buying individual stocks. So if you're going to buy individual stocks, definitely want to do some research on the stocks you want to buy. Now, there's some big names like Apple and Amazon. Everybody know, okay, I want to buy them and hold on to them. But there's still even you go want to research that because you want to buy it at the right time.
Right. So say like, for instance, like AI technology.
Right.
Now, if you jumped into that,
exactly,
that'd probably be a good thing to be getting into.
Exactly.
But right now, that's probably stocks up there. They're probably higher than they was when they first came out.
Oh, absolutely. That's all everyone been talking about is AI. So some of the AI companies now, their stocks are really high, but there are some out there. That's where you want to do your research. There's some companies whose stocks are not that high that are doing some research and some applications in the AI, but nobody really knows. They haven't come out with that product yet. And when they do come out with that product, their stock's going to take off. It's just no different than pharmaceutical companies. Imagine if you had gotten in some of these companies before COVID-19 vaccines came out. It's the same thing.
I did. I got in the Moderna and I lost money.
You did?
You might like get in the Moderna.
You probably got in after everybody knew it, talked about it.
I got out there a little late.
Yeah, but then you hold it though. It's never lost until you sell it.
I got nervous.
Yeah, see? Yeah, like I said, I hold it. I hold. See, a lot of people don't like to see their account go down. Don't watch it. You know, don't watch it. And don't be a short-term purchaser unless you're doing day traders. But even day trader, you can lose a lot of money. But people who do day trade, I'm talking about serious traders, they really know how to watch it, know when to buy it and everything. And then they hold it and they sell it. They may buy like 100,000 and sell it when it goes up $2 in terms of that. So they have to be careful with that.
Is real estate a good investment? Commercial real estate, buying properties, renting them out, or buying them and trying to flip them?
It can be a good investment. It obviously depends on the market. You got to know when to buy, when to sell. And if you're going to rehab a property, you got to know what you're doing. I represent a lot of real estate investors, and some of them are good and some of them are not so good in terms of that. The good ones know their margins. They go in, they can take a look at a house, how much it's going to cost to invest in that house in terms of that. And some of them don't sell them at all. They just rent them.
Rent them out.
As far as that's concerned. So there's a market
for that. Keep them over the long haul.
They keep them over the long haul and they build up a huge portfolio. I have some investors that have a huge portfolio of homes and they rent them out in terms of that. And so a lot of them, sometimes they just use the Section 8 because you get your money on the first of every month, right? And then what they do is that they'll get so many homes and they'll do what is called bundle financing. They'll bundle finance, that means you rehab, because most of them doing hard money lenders. And hard money lenders at higher interest rates, and you got to pay it off in 1 year. And so at the end of the 1 year, they'll take a bunch of homes that they have and they'll refinance into a conventional loan over a 30-year period at half the interest rate. So it goes down from 12 to 6, and then they'll cash out some of the money. So they take some money in their pocket and then they'll invest that in new additional property. So they continue to build portfolios that way. So you would say diversify your portfolio. You should add some, real estate. Yeah, you can add some real estate in portfolio if you, in fact, can do it. Now, to me, you got to have the throughput to be able to buy real estate and flip it and rehab it, or you can hire someone to rehab it because you got to watch it. Otherwise, it can be a bad investment in terms of that. And some people don't like the property management portion of real estate. So you got to be careful with that, dealing with tenants During COVID-19, I know people who had a whole bunch of units, and the state said, hey, nobody has to pay their rent, and you couldn't kick them out. You got to be.
So, you gotta be careful. You get a bad tenant in there.
Yeah.
They know the system.
Exactly. You get people who take advantage of things that come out, like the rent, a moratorium that Illinois had. You couldn't kick these people out. So, and if your money not right, that's another thing about being financially independent as a business. You got to have some cash on hand in the event you get into circumstances like that, in terms of that. You should have a line of credit too, but from a business standpoint, your line of credit should be secondary. Your cash
flow. Have something put away for just certain
exactly
like
certain circumstances. Exactly. Right. You should have that money put away.
So, were you taught finances, or you were self-taught?
I was self-taught. I wish somebody did teach me finances. I was self-taught. I didn't learn it until my 30s. I was self-taught. And it's easy to be self-taught today as opposed to when I learned it. I learned it by reading Business Week magazine, Forbes magazines, and by going to actual seminars. The first trading platform that I joined was E-Trade. So the E-Trade at that time was down on Wacker Drive in Illinois, and they would give anybody who was a member online, they would offer free seminars in the evening after work. I would go down there just to obtain the knowledge. Now you can put all this up online.
Yeah.
You can learn it, in the confines of your own home at your own convenience.
So it shouldn't be no excuses why you
It shouldn't be no excuses now why you do it. It should be no excuses at all. And a lot of young folks are doing it. So I'm not saying that a lot of them are doing it. Especially that FIRE movement really got some people fired up, but a lot of folks are doing it. I just think our community is underrepresented in that game. That's my concern. They're underrepresented. That's going to
be my next question. Are Black people afraid to invest?
Yeah, I think they're afraid to invest because they don't know. See, people inherently are afraid to lose their money, which I think is kind of interesting because
that comes from somewhere.
That comes from somewhere. Oh, I agree. And I'm not quite sure where it comes from. But I find it. But
you trying to get some money.
Yeah, exactly.
You don't want to lose it, boy.
But on the flip side of that, though, think about it. It's losing if you're going out and purchasing a lot of depreciating assets, a lot of things that don't really have value. Are you technically losing your money? I mean, we'll be quicker to buy a Gucci purse or a Gucci pair of shoes that we may not wear after a year, and we done threw that money down the drain, but we won't buy.
We buy it for the instant gratification.
Exactly.
When you get it, you want looking good when you go out.
Exactly, but we won't buy stock because we're afraid we're going to lose. That, to me, has always been an interesting dichotomy. So that's the thing. But I think, one of the reasons they don't get in the stock market and investments is because they don't really know in terms of that. In the generation that I came up with, obviously that fear was there, but there was a lack of knowledge. We just didn't know. Now that information permeates through all social media now, all type of platforms. These trading platforms pop up like advertising.
But if they're not searching for it?
Yeah, right. They're not searching for it.
Even looking for it. They go on YouTube or go on some of these other platforms and go to what they like to look at. Right. They ain't thinking about looking at other kind of channels.
There are YouTube.
Like you said,
they're out there. There are YouTube videos to teach you how to buy cryptocurrency, buy stocks, shorts, puts, everything stuff that you would have to go to school for back in the day. They're giving it for free now.
So now that you brought it up, what is cryptocurrency?
That's a good question.
Is it digital money?
That's primarily really what it is in terms. I own a little bit of it, but only because of the fact is I'm not saying I'm a necessary believer in cryptocurrency. I am the type of person that believes you have a diversified portfolio. So you never know.
So you're like, let me get a little bit.
Let me get a little bit of that and hold on to see what happens. So you never know, in terms of that. And my whole thing is too, you shouldn't invest money that you can't afford to lose. So that's the whole thing too, as far as that is concerned. Your primary source of investment should be in what are secure investments. Like a lot of financial wealthy people like Warren Buffett believe cryptocurrency and nothing but a whole bunch of junk. That could be true. They don't believe in it. And everybody has their opinion. I understand that as far as that is concerned. So the bulk of your wealth shouldn't go into that. No, because it's still an unproven asset, right? As far in terms of its usefulness and so forth. It may turn out to be something real in terms of that. So
how should a person invest? Should they be putting money away every month, every 2 weeks? If you're trying to get there, it's got to be a consistent.
It's got to be consistent. Consistency is the key. I'm a creature of habit. I do things. But you got to start doing it so it becomes comfortable to you. So it depends on when you get paid or how you get paid, right? As far as that's concerned.
So you got to set up these financial goals.
Yeah, you set monthly or weekly in terms of set up a financial goal. What I say with people who are starting out, in terms of, like I said, depends on their income. But to get people used to an idea that they're not familiar with, start out with a small amount of money and put it away on a regular basis. And then increase it. Let's say, for example, you work and you're coming out of college at 22, you get a job. Start off by putting, let's say, 5% away. If the company requires 6% for you to match your 3%, put away the 6% and get that free money. Never leave free money on the table. And so start that. And then every year when you get a raise, take half of that raise and invest half of that raise. Keep half because you want to reward yourself for the hard work that you've done. That gives you the incentive to keep moving, right? But it's so you can go that route as far as that is concerned. So that's what I would recommend.
Time, be having a Roth IRA or something else on the side that you're investing in besides
absolutely
your 401k.
That is absolutely. If there's one thing that I would tell young people, if you can get money in a Roth IRA every year, you'll be set. You can do that for 30 years because the fact is that it grows tax-free. And when you start drawing down on it, you don't pay any taxes. That's the biggest game in town. That's the biggest game in town in terms of that. And there are a lot of other financial instruments that allow you to do that, like insurance policy where you can cash out tax-free based on the basis. It's more technical. We don't need to go into that now, but that's how the rich people get out of paying taxes as far as that is concerned. And people want to know, for example, why rich people have a smaller tax percentage than your average person. A lot of rich people buy a lot of equities and stocks. And so what they end up doing is that once you hold them for a period of time, then all they're doing is paying capital gains on the dividends that they make. Capital gains tax is much less than income taxes. So you see people like Mitt Romney, all his income comes from capital gains. So his tax percentage may be 10, 15%. People say, well, he getting millions of dollars in cash, but it's capital gains. And so that's how they play the game to be in a lower tax bracket. A lot of people complain about folks not paying taxes, but the tax system is set up for those who can play the game to benefit from it.
Yeah.
In terms of that.
Okay, but before we get ready to wrap this up, does inflation tie into any of this?
Yes, it does, because inflation can erode your purchasing power. So that's one of the reasons why you want to invest in stocks early on, because stocks is our hedge against inflation. So because inflation always outstrips cash, unless you invest a whole lot of money in the bank. You can dictate, hey, I want 5% interest rate. I got to beat inflation every year. But the average saver can't. You put it in the bank account. I mean, you've seen some of these bank account savings in terms of that. Interest is nothing in terms of that. I don't even have a savings account. All my money's in there.
Savings account?
I don't do a savings account at all. Checking account to pay my bills. All my money on brokerage accounts. All of them brokerage accounts. I have a joint savings with my wife because that's what we would try to do as a emergency fund. So you should have something like that. But I personally don't put money in savings accounts for any kind of growth. No, for any kind of savings and growth. Yeah, because savings accounts give you nothing. In terms of, you have checking account in the event you want to pay any bills, any emergency funds, or anything like that. But savings accounts, no. And with your brokerage accounts, you can get access to money so quickly, who cares now?
So through your brokerage account, if you took money out, no penalties, no fees for that, right?
No, your brokerage account is all your money, yeah, in terms of that. So what you can do is that, say sometimes in your brokerage account, you got a number of stocks listed, right? So if your stock is in a positive territory, you can choose to sell some of your shares. And when you do sell your shares, those shares go into a savings account, so to speak, as that's a part of the brokerage account. You can use it to repurchase stock. That's what people who have investment accounts do. They say, well, okay, this stock is up 50%. I'm going to take my money off the table and I'm going to use it for an investment down the road, right? Gotcha. That's how they do it. Yeah, so you have access to that money real quickly. And you can transfer to one of your accounts easily and quickly if you really need to get access to the money. But you keep money around where you can get access to it. You don't have to touch those accounts. So that's easy to do. Keep your money around in terms of that.
Okay, so before we wrap this up, you telling me it is a way to get financial freedom out here.
Oh, absolutely.
It's not a lost cause.
No, it's not a lost cause. It's actually, it requires discipline and it requires consistency. That's all it really is. I mean, in time, consistency in time, right? And so the younger you are, obviously the better chance. But even if you're older, it's never too late. You just probably required to put more money away.
Yeah,
that's right.
So you can do this starting at 40.
Yes, you can do it starting at 40. Easily starting at 40. In terms of easily, particularly if you have been in your career for a while or you're professional entrepreneurs. I mean, everyone has an opportunity to invest in terms of that, and you're making good money as far as that is concerned. And so you can easily become successful, even starting at 40. It depends on when you want to retire. Some people want to do it at 60, some people want to retire at 70. So it's about your horizon. It's about time.
I'm 51. Can I retire at 55?
Well, it depends on what you have. That's what it depends on, what you have.
I started late.
It depends on what you have, and then it depends on what you want your lifestyle to be. So understand that, okay? I want to be able to have X% of my current income when I retire. to draw down from my retirement, right? So let's say I make a easy number, 100 grand a year. When I retire, I want to be able to live off $50,000 a year. Well, okay. Now it depends on your age. And then they do calculations based upon your lifespan. You figure out that nice, okay, I may live at 88, I'm leaving at 55, I'm leaving 80 at 30 years. What kind of money do I need to make it 30 years? Now, we're not talking savings, we're talking about a good portion of your money still in stock. So it's going to continue to grow even though you draw it down, right? Because you're not drawing it all down, you're just drawing, let's say you have $500,000 in your investment account. You're only drawing $50,000 a year. And if your account is returning 10%, then you're breaking even. That's right.
So that's the money that you actually making.
Exactly.
You're just taking that out.
You're just taking it out.
Okay, one last question. You consider yourself an entrepreneur?
Yes, I am. Yes, I do consider myself an entrepreneur. I think the good thing about being an entrepreneur is that it widens your mental breadth of what's going on in society, how it helps you to be able to look at things from a business standpoint, from a personal standpoint, because entrepreneurs usually meet other entrepreneurs and you get ideas as far as that are concerned. And investments is one of those ideas that you can get from other entrepreneurs, because there are entrepreneurs who are in the investment game. Right. They own their own brokerage houses or whatever they do. So in terms of that, so yes, absolutely.
Good. Thank you, Brother Darryl, for joining us on the second episode of Behind the Camera in beautiful Miami.
Absolutely. I'm glad to be here.
Behind us. And we're gonna kick it. Why was it when we was out here for the African American Film Festival?
Yeah, American Black Film Festival, what they call it now. Yeah, absolutely.
Okay, and they had those every year out here.
Every year around the same time frame in June. So that's why we're out here to obtain more knowledge, to be able to get our clients in that certain area of law that I practice, pick up hopefully new clients in terms of that. But even a part of the film festival, they have a segment where they talk about financial health.
Yeah.
In terms of that, because even when filmmakers is an entrepreneur, directors is an entrepreneur, people who are employed, everyone is making money. Everyone and they need investors. And so, Prudential was out here doing that for them. And so it obviously introduces their product, but at the same time, they're giving you knowledge. And so it's important. When you start making that money in the film industry, what do you do with it next? A lot of people don't think about that.
Put it into making
Exactly. What do you do with it next? You don't want to end up broke, in terms of that. Now, a lot of the athletes are getting on the same page. Now, a lot of them are being smart about it.
Yeah.
They're being real smart about it. They make a lot of money and so.
Appreciate it, Brother Darryl. We're going to wrap this up. Another episode of the Behind the Camera. Darryl E Robinson, attorney. And we'll see y'all.
All right.